Welcome to Focus on the Five, conversations with Baldwin County business leaders and entrepreneurs, brought to you by Josh Knoll of Gulf Coast Financial Advisors. And now, Josh Knoll.
Hey, how y'all doing today? Josh Knoll here with Gulf Coast Financial Advisors, coming to you from downtown Fairhope, Alabama. If y'all could see what we were having to do to get the sound quality corrected today, you would have a pretty good chuckle. But thankfully you can't. So let's just go ahead and dive in what we're going to talk about. It's a question that I get asked a lot. And the question is, what does a financial advisor cost? Now, this seems like a pretty simple question, and it is. I mean, honestly, there should be a simple way to answer it. But it's like an onion. There's layers to the answer of that question, to answer it correctly anyway. To answer how much a financial advisor costs, the first thing you really got to do is define what is a financial advisor. Now, this is going to be where I tiptoe around just a little bit, because there are folks out there that hold themselves out to be financial advisors. And then, walking down the street, regular Joe, regular person, may view some other people in our industry as financial advisors. We tend to get kind of lumped together. And as I go through what is a financial advisor, I want to make sure that I'm not belittling some of the folks that may not have the different securities licensing, things like that, because, quite honestly, I came up with, I started out my career with just an accident license. So there's no judgments being made here. I want to make sure that we're clear. Before you can define what a financial advisor costs, you need to define what is a financial advisor. And what I'm going to do is I'm going to go ahead and kind of lump everybody into that category, because we get lumped in anyway. So, why fight it? I'm going to give you all, the terminology and the licensing behind all of this. The other thing we're going to do is we're going to stick strictly to the retail space definition of a financial advisor. There is a whole world ecosystem of people that are financial advisors with different securities licensing that the average retail client will never meet. They work in more of a wholesale environment. They work inside the brokerage houses, whatever it may be. The general public does not deal with a certain segment of the market that would be technically financial advisors. We're going to deal with the retail space of this. And so when we deal with the retail space of this, more often than not, when someone is defined as a financial advisor, generally speaking, it means that either they have a Securities Series 65 license or a certified financial planning, maybe a certified financial analyst, CFP, CFA designation. There are certain laws and rules to even use the term financial advisor. I'm not going to go down that rabbit hole. If somebody doesn't have that license, the Series 65 or some of the other proper designations, and they're still calling themselves a financial advisor, fine. Not my battle to fight. I just want, when folks ask these questions and when you're trying to compare different quote-unquote financial advisors, I'm trying to help you all compare them in an apples-to-apples scenario, because honestly, more often than not, when someone comes in and asks that question, if I'm an apple, they're comparing me to an orange, and they're comparing another guy to a pickle, and they're comparing another guy to grapes. I mean, we're all a bunch of fruit and vegetables, but we're wildly different in the approaches, how we're compensated, and the things that we're legally allowed to do. So what we're going to do, we're going to build up from the bottom. We're going to start, and it's honestly kind of follows my progression in the industry. And what we're going to do is we're going to work through the way that what does a financial advisor cost? So again, keep in mind, I'm going to lump everybody in together. So those of y'all that are in the industry or happen to be a little bit nerdy about this thing, I'm going to be calling a life insurance licensed person. I'm going to be throwing them into this financial advisor category. Don't get mad. It just keeps things a little simpler for now, right? All right, so first, the entry point on one side of the industry is getting your life license or getting your life and health. That is a common entry point into what we call the financial services industry. And when someone gets a life and health license or a life license, if they do anything related to retirement planning, savings, things like that, they're going to be legally allowed to operate in a fixed environment. What I mean by that? That means that the products they sell, even if it has to deal with retirement funds, they are going to be put into a general account of the insurance company, and there's going to be some type of guaranteed growth, some type of guarantees with that. There might be some extra things thrown on the top in the form of company dividends, but what there is not going to be is overall stock market exposure, true exposure, or risk. The majority of the time, if you sit down with a, again, quote unquote, financial advisor that is life licensed, more often than not, what you're going to discuss are going to be fixed annuities, whole life solutions, and index annuities. Fixed annuities, index annuities. At least you should not be, if they only have a life license, is you should not be in any type of variable product discussion. Variable annuities, variable universal life, definitely not stock market, mutual funds, things like that. So what you'll find, especially here over the last, I'd say, kind of coincides with the bull market run, but what you're going to see with a lot of life license guys is index annuities has really made an explosion. Now, that is a whole nother podcast, and we'll get to it. So there's going to be some of you out there right now that are cheering when I say indexed annuity or fixed index annuity. There's going to be some of you all listening that are in the industry that are cringing. It is absolutely a polarizing subject. I don't want to go down that rabbit hole either. What I can tell you is that a fixed index annuity, or commonly referred to as index annuity, is a product that is allowed to be sold by a life license only person. And what it does is it mimics a stock index, like an S&P 500. That's a common one everybody knows. Now, it technically does not, you heard what I said earlier, a life licensed person cannot sell anything that actually has securities products in it or variable products in it, right? But they can on an index annuity. How they get around that is the index annuity is really it's kind of a mirror of that index. Let's just use S&P 500 for now because that's the most common. And what happened, what the insurance company does is it says, hey, we're going to give you a floor on your growth. You got money in an account, goes into this index annuity, and it grows. We're going to give you a floor. Normally it's 0%. I've seen a few that had 1% floor. No matter what happens to the market, whether it goes to 0 to -5, -20, crashes, whatever, you're never going to go below 0%. On the flip side of that, you're going to be offered some upside potential, maybe even potentially greater than what you would see in a fixed annuity, a fixed period annuity, which is often a little bit more comparable to like a CD rate. So on the index annuity side, you've got some upside potential, but the insurance company is not going to give you unlimited potential. They're going to put what's called a cap rate. And you have a cap rate and you've got participation rates. You're going to get a certain percentage of whatever that market index would have produced over a certain amount of time. So let's say that the stock market did 8%, and your cap rate is 7%, and you've got a participation rate of 4 or 5%, I'm just giving you raw numbers, you'll see that number, that percentage credited to your cash growth of your index annuity, right? Sounds great, right? The issue, the one thing I will say that guys on my side of the table on the Series 65 license and all that, the fee side, the things that we do deal with, the things that if I have any aggravation in that space, is that often whether the client, potential customer misconstrues it or whether it's misrepresented, I don't know. I don't want to throw bombs blindly. But a lot of times I'll have the payout rate is what someone will come in and tell me that they've been guaranteed is going to be the growth on the money in the account. And the payout rates are generally pretty healthy, 7, 8, 9, 10%, whatever it may be. We'll have another podcast on this. I'm going to bring in some industry experts on index annuities. But the one thing that I can tell you with certainty is this. The return of your money is not the same as the return on your money. So remember that. It's a humongous difference. And again, I don't know if it's how it's taught. I don't know if the clients get confused, whatever it may be, but we do see people come in, and they'll come in and they'll tell me, hey, I've got this thing that guarantees me 8%, 9%, 10%. And it takes me usually a couple minutes. I'll show them, hey, that's what they're referring to as a payout rate. And as time goes on, and if you have this annuity for a long time, this index annuity, you live a long life, and the market does its thing, and hey, pretty good chance that thing's going to pay out pretty well. obviously as long as it's backed by by an insurance company that can withstand the markets being down for a number of years if we ever have a prolonged bear market. But really what you need to look at is cap rate, the participation of that cap rate, and you also want to make sure that whatever it's indexing is something that you've reasonably heard of. You really don't want to have some crazy index that thing's going off of. All right, now I'm going to jump back just a little bit because if you watch TV, you see Ken Fisher on TV a lot, and he obviously bashes annuities quite a bit, and he has some points. Again, I don't want to go into too many rabbit holes here. Annuities do tend to be expensive, but you're trading expense for some safety measures. The thing that I want you to take away from this discussion is, while we're lumping in the financial advisors into one pool, annuities, it's almost impossible to lump them all together, because a variable annuity is radically different than a fixed annuity. And even a fixed annuity can be a fixed period annuity, kind of like a insurance version of a CD, if you will. And it can be an income annuity where you give the insurance company a chunk of money, like $100,000, and then they agree to pay you a certain amount per month or per year, where it may be, for the rest of your life, and maybe there's survivor benefits on it. And so that, as we bring up the different kinds of annuities, that's a great jumping off point to our next level of quote unquote financial advisor, and that would be the registered representative. Now, the first level we talked about was someone with a life license. Again, they tend to, the solutions are going to be normally based around fixed annuities, whole life, potentially index annuity if their insurance company offers those things. When you get into the registered rep space, well, now you can get into variable products, right? Now you can get into variable annuities. So let's talk about variable annuities first. A variable annuity, as opposed to a fixed annuity. Fixed annuity, put your money in, it goes into the insurance company's general account. It has certain guarantees, certain gross. If you're in a participating company, maybe there's some dividend potential on top of that, but it's just a slow, steady decision on what you do there. The variable annuity has a separate account, and that separate account is actually going to own various funds, various market products, right? And it's going to go up and it's going to go down. Now, on the variable annuities, they have a lot of bells and whistles. They can, there's death benefits, there's ways to lock in some of your growth. A whole nother discussion. Just understand, if you're with a registered rep, what that means is they have taken the time to, normally they start out with a life license, then they took the time to get their 6 and 63, and I think there's a way to combine that. I can't remember what that is. Maybe that's a 66. Somebody can correct me if they want to comment back on this. I did the 6 and 63 route. All right, so your registered rep, you go in, he's going to propose a variable annuity. He's also got the access to a variable universal life. That's kind of like a whole life, except, again, instead of the money being in a general account fund of the insurance company, on a variable universal life, now it's in a separate account that has market exposure, and it can go up and it can go down. And of course, there'll be some death benefit features of that makes it a life contract. And there's also, with everything I've just mentioned to you, there's tax deferral, there's tax-free growth, there's all these other features. I'm trying to give you the definition. Here, see how long this has taken to get what a financial advisor costs? Just hear me out on this. All right. Also, registered reps, generally speaking, can do brokerage accounts. A lot of times they can do Class A shares. There used to be other class, well, there still are, but Class B and C, you just don't see a whole lot. So registered rep can do brokerage accounts with Class A shares with a upfront sales charge. All right, then the next level of licensing is what used to be, it's kind of funny. When I was a kid, Wall Street, the movie Wall Street came out, and those guys on there, they're stockbrokers, and they're calling people and driving fancy cars and making money and all that. Well, I didn't realize at the time, I didn't realize at the time that those guys were securities licensed. They had a very specific license. It was a Series 7. And what that did is that allowed them to sell individual stocks and bonds. And the funny thing is that, there are people that still have Series 7 license. There's things that we use in our world. I have a Series 7 license. But the old traditional stockbroker is gone. I mean, it's really gone. I mean, when's the last time you called somebody and said, hey, buy me 20 shares of Apple? Well, you don't do that. You just go online, or you call your advisor and they mix it in with part of your other portfolio. But you don't call a stockbroker necessarily anymore. But there's Series 7 licensing allows sale of individual stocks and bonds. from an advisor to a client or customer. It was a little bit more of a transactional relationship. All right, and then lastly, of all the financial advisor terminology is a Series 65. Again, all you nerds out there, I know there's Series 66 and 24 and all that. I'm just talking about, we're just getting the general terms of the retail-facing financial advisors. And a Series 65 is where you kind of start seeing things separate a little bit, because that allows you to be a fee-based advisor. And what that means is you can charge a fee on the client's assets that you may manage. You can charge an hourly fee. You can charge a lump sum plan fee. I mean, you basically can charge it any form or fashion that you want. Not unlike a CPA can charge you by the hour or charge you by the filing your taxes, although they don't necessarily do financial advising, but you get the idea. So when someone goes Series 65 or some nomenclature like that with the fee, they have a choice of being fee-based or fee only, and we'll circle back around that. Just remember that. So, all right. So now we've laid out the handful of different ways that someone can be licensed and kind of present themselves as a financial advisor. Although, again, legally, you're only supposed to use that terminology with certain securities licensing or certain designations. But let's start with the life guys. The life guys and the registered reps. Well, let's start with the life guys. On any life licensed person, fixed annuities, whole life, index annuities, whatever it may be, the insurance company will be paying the commission to the agent. All right? Hear me out. The insurance company pays the agent a commission. Doesn't necessarily come out of your funds. You don't write a check to the agent. Insurance company takes care of that. Right? Sounds great. And it can be, especially with life insurance. Life insurance doesn't need to be that complicated. Go in, buy your life insurance, pay the guy some commission, move on with your life. Get over it. You guys are worried about commissions. But understand that in exchange for you paying this commission, especially in the annuity world, there's a give and a take. And the give part on your side is going to be surrender charges. So what the insurance company is going to say is, hey, give us your chunk of money, and we're going to make certain promises to you in this fixed space. And after a certain number of years, we require you to allow us to lock this money up for a certain number of years. That's a surrender period. That could be 6, 7, 8 years. I mean, I've seen index annuities with 12-year surrenders. Generally speaking, the higher the commission on the product, the longer the surrender period. That's how the insurance company makes sure that they don't pay this insurance agent a bunch of money to sell this product, and then the person cancels and takes all their money out a year later. If you take your money, you can take your money out, but you're all going to pay for it. All right. So that's surrender period. That's how, when you want to know, when you walk in, somebody has a life license and they're holding themselves out as a financial advisor that deals in retirement accounts, and you want to know how they're paid, they are paid on commission by the insurance company. All right. So that leads us right into the registered rep space as well. If you deal with a registered rep, they've got a 6 and 63 typically, and they're dealing with variable annuities, variable universal life. Those too are commissionable products where the commission is paid by the insurance company. And again, I'm speaking with the variable annuities, there's going to be a surrender period there where the insurance company says, listen, we're going to take your money in. We're not going to chunk anything out of it necessarily to pay this registered rep that sold the product to you. But we're going to make sure that you don't take the money out anytime soon. We're going to put a surrender period on there, and there's going to be penalties if you pull it out, which kind of coincides a lot of time on a variable annuity. Not every time, but often it is used in some type of IRA wrapper. So a lot of times those two things go together. All right. So life and health license guys, registered reps, those guys get paid on commission by the insurance company. You don't pay them directly. However, you do give up the ability to access your money easily for a certain number of years. Remember that. All right. Stockbrokers, all right, so registered reps and Series 7 guys that can do brokerage accounts. They are on a Class A share. When you want to know what does your advisor cost you, now we're switching over to a different environment where you're starting to chip in towards this advisor's pay. Those are still commissionable products, just like you saw with the insurance space. However, this part, for example, a typical Class A share has somewhere in the neighborhood of a 5.5 sales load. So what that means is when you buy, let's say you buy, let's do $100,000. You buy $100,000. Now let's do $1,000. That's a big number. Let's do $1,000 of a Class A share. there's going to be, what is that, $55, let's say it's 5.5. So $55 of that is chunked out in the sales load. Part of that goes to the broker-dealer that the registered rep or the stockbroker may be clearing through, and part of that, then the broker-dealer is going to give that registered rep and that Series 7 guy a piece of the action, okay? Now, my fee-only guys that have hung in there and listened to me to this point, I'm not going into are commissions bad or good, right? There's something to be said for the buy and hold thing. That's a whole nother podcast. But I want people to understand that when you start getting into the brokerage accounts, into the individual stocks and the Class A shares and things like that, now it's switching gears from the insurance company paying the person to now the money's really coming out of your money ultimately through the form of a sales charge. Now the difference being is there's necessarily no surrender period, but if you buy some Class A shares and turn around and sell them real quick, well, you just paid a sales load that you're not going to get back. A lot of times, most reputable broker-dealers and other companies will require what's called a burn-off before they'll allow an advisor to swap over a Class A share into like an advisor share. They usually want to see 2 or 3 years for that share, that Class A share, to have time to kind of recover the sales load and maybe grow a little bit. All right, finally, let's get into the fee side, the Series 65 side. Certified financial planners, all those. We're just dealing with the Series 65 for this talk. They are paid a fee. Now that fee, 100% comes out of your pocket. Okay, so when they make a recommendation, they have all these different products, all these different not products, excuse me. They have all these different securities they can pick from. Well, the securities don't pay the Series 65 fee guy any different. It's all the same. It's all one shade of black or one shade of gray. And so in theory, what they can do is totally operate in your best interest. Pick whatever model portfolio, put whatever bucket of investments together that suits your best interest, and not worry about what are they getting paid for the individual advice. They're just getting paid directly by you. It's a flat fee typically. There's a couple different ways that the fee-based or fee-only financial advisors charge. A lot of them do asset under management. That's what we do. They can also charge by the hour. We have scenarios with that where somebody doesn't necessarily want me in there managing their account per se, but they would like a second set of eyeballs to look at it once a year or once a quarter. That's fine. And then some of them charge a planning fee or charge per year set amount. To me, that seems a pretty difficult way to hoe. One, the fee they have to charge in the beginning is usually fairly large, which means that you're going to almost immediately knock out your kind of middle road investor. And two, people have wildly different changes of scenarios as life goes on, as the years go on, especially if they're a business owner. You may be at one level in your 30s, and by the time you're 40, you're at a completely different class. Well, the planning fee would need to adjust for that. All right, so why do we bring up the fact that they fee only and the fee based charges level fee? Well, here's why. Here's where the heartburn and the separation comes from, the cats versus dog discussion, because in the life insurance side, the registered rep side, the brokerage side, the stockbroker not as much, but the registered rep side, the life side, basically anybody that can't charge a fee. The different products and services, the whole lives, the fixed annuities, the index, the VULs, all that, they all pay different commission rates. Hear me again. There is no set standard for what a company pays on commission. And those sales usually only have to be done with suitability standard. Again, another podcast, hang with me. But those things all pay different rates. So in theory, the concern from the fiduciary side of the table is a registered rep, life guy, he's just going to make recommendations based on, or she is going to make recommendations on what pays them the most. And to be fair, absolutely that happens, right? But there's also good people out there that have those licenses and they do things for a reason. Maybe they like the slow and steady growth of a whole life. They like the fixed, they like the promises. And they don't necessarily look at that. They just try to do what's right by the client. I can promise you that I've seen knuckleheads on both sides of this table. I've seen people, swear up and down their fiduciary, and then they are, basically, anyway, we'll back off of that. All right, so on the fee side, there's going to be a level load. I don't even want to give you a level fee. I don't want to give you like a blanket number because it has changed and different people charge different things because there's all kinds of different levels of services and things like that. And even in the Series 65, I mean, there's 4 or 5 different ways a guy can go how he wants to, is he a financial planner? Is he a wealth manager? Is he all above? And what does he charge for those services? The old rule of thumb, if you will, like kind of the industry standard, 1% of AUM, which is asset under management, you'll see a lot of that, and that's okay. So that's kind of a general rule of thumb. But with the spread of technology, with the investing side of these things becoming a little bit more of a commodity, you're seeing a lot more dynamic pricing structure. You're seeing, especially if you start getting considerable assets in the door. All right, so let's wrap this up. What does a financial advisor cost? You're probably more confused now than ever. But what you need to know when you walk in and you ask that question, the more important question is, what licenses do you have? The person you're talking to. That's really more important than, not more important, but that's going to be part of the answer of what the financial advisor costs. Understand that if the financial advisor has a life and health license or registered rep, generally speaking, on the insurance products that is being presented to you, they're going to be paid a commission by the company. Doesn't necessarily come out of your pocket, but you're going to trade some liquidity to make sure that the insurance company basically burns that commission off at some point, right? If you're dealing in Class A shares, in brokerage accounts, things like that, you're going to pay a sales load. Now, there's been a lot of pressure on that. There's been actually invention of some new classes of shares. Whole nother podcast, the nerd people that are still with me on this, okay? I'm talking about Class A historical shares paying a commission. They're a commissionable event. Everything I just listed up to this point is, generally speaking, a suitability standard. All the insurance agent or the registered rep has to prove is that the product was suitable to your situation, all right? And then lastly, you have the fee-based side. And on the fee-based side, what you're going to have is, now this is where you switch over that in the Class A shares where you're paying the fee to the advisor. The good thing about that part, the reason that I have my Series 65 is there's something to be said that there's really no, when I'm going to looking at the different basket of investments that I can choose in someone's portfolio, none of them, they don't pay me anything. The client pays me. So I don't have to, I'm not going to pick Apple stock over BMW just because Apple has a higher commission rate. It's irrelevant in the advisor space, all right? So you're paying the fee. It could be a fee, an asset under management fee. It could be an hourly fee. It could be a planning fee. It could be a combination of all 3. And there's probably guys out there doing things I haven't even heard of. But the point being is you're paying the fee, and there's a fiduciary standard where that advisor has to be able to prove that he has operated in your best interest, okay? All right, so now you've heard the different ways for, quote unquote, what does a financial advisor cost? Again, the most important thing is figure out what are they licensed in. That'll give you an idea of what you're getting into from cost, fees, commissions, all the things, the ways we make money. Me, Josh Knoll, Gulf Coast Financial Advisors. What's our take? So we are a fee-based advisory practice. Now, what's that mean? That means that I have a Series 65. The majority of my practice, especially with my qualified accounts, my planning, is going to be fee for service advice. Asset under management, got some hourly stuff we do, all that, right? Fiduciary standard, on and on and on and on. However, I am also, because I've been doing this so long, I also have a Series 7 because I deal with buy and hold people. My Dave Ramsey folks out there have been listening to this point, listen, I can choose to die on that hill or I can choose to help you all. And I have no problem if someone is die hard, buy and sell, or buy and hold. And what that allows me to do with the Series 7 is allows me to play in that space, especially my younger investors that have time. Do you want to pay 1% a year on a fee account if you're a passive investor for 20 or 30 years? Or if you're a true buy and hold, which I'm going to drill into you, make sure that you understand what that means. Do you want to burn off a 5.5% commission in 5.5 years compared to the 1% asset under management? Just do the math, right? All right. On top of that, also, I have my 6 and 63. Now, I don't do a lot of variable. Actually, I say not. I don't. Variable annuity side for our practice is going to be really a specific case by case. You never want to you don't want to paint yourself in the corner because people walk in with situations that are unique all the time, but when you're a fee-based planner, you generally speaking are not going to be dealing a lot, or most that I know anyway, are not dealing a lot with variable annuities, VULs. They're not dealing with whole life per se, although there's some things that we do with executive benefits and business planning where permanent life insurance plays a part. And then there's things we do with fixed income annuities, and then there's things we do with fixed period annuities. So I have my life and health license as well. The main thing is when we went independent with Gulf Coast Financial Advisors is I did not want to have a limited toolbox. I wanted a full toolbox so that I could help all clients in all situations of all ages. And when you paint yourself into a corner by being necessarily just a life license guy, or on the other side of the spectrum just a fee only guy, there are things that clients need, for example, life insurance, that you really can't effectively do if you don't have those licenses and having built up the relationships and the network that I have, so I can know where I can get the best deal, and plus also I can get the best fit for my client. So to summarize, since you now know the different kinds, I have my life and health license. I still have my accident license, by the way. I have my Series 6, 63, my Series 7, and my Series 65, which what that tells you is I'm a gigantic nerd. And it also tells you that I've been doing this a while, and that we have a lot of guys will call that a holistic practice. The main thing is when someone sits down and we do their financial planning, we are focused on not only planning their upside, but we also focus on planning their downside. Life insurance, disability insurance, long-term care, things of that nature, things that the average person can come in pretty handy when things go sideways in their life, right? So that is how we approach our practice. Those are the licenses. You'll hear a lot of guys in my industry harp on transparency, conflicts of interest, fiduciary, all those things. And it's good. The more open the dialogue, this stuff, my side of the business was literally, 15, 20 years ago, this stuff was all done behind closed doors, and people were getting taken advantage of in manners you'd be appalled. So it's good that the discussion is out there. It's good that there's sides pushing against each other. There's conflict. What we try to do here is, to me, it's more than just transparency. It's about being an open book practice. It's about people knowing why I'm getting paid, what I'm getting paid, and what the value I'm providing for it. And it's also about, it's more than just, in my opinion, it's more than just fiduciary. Fine, I can sit and tell you, hey, I've got your best interests in mind. But at the end of the day, who the heck's looking out for you? That's really number one thing, you. All right, hey, thank you all for all of this time. This is something I've been wanting to record for a while. It's something very near and dear to my heart because I get asked it a lot, and there's just a lot of confusion around it. Hopefully this helped. At the end of this recording is going to be my contact info and my disclosure. Again, Josh Knoll with Gulf Coast Financial Advisors, located here in downtown Fairhope. You have been listening to Focus on the 5. Have a great day.
Thank you for listening to Focus on the 5. If you are interested in learning more about Josh Knoll and Gulf Coast Financial Advisors, you can find us at gulfcoastfa.com, call 251-327-2124, email josh.knoll@gulfcoastfa.com, or message us on Facebook. Focus on the 5 is produced by Josh Knoll of Gulf Coast Financial Advisors. Advisory services offered through Investment Advisors, a division of ProEquities Inc., a registered investment advisor. Securities offered through ProEquities Inc., a registered broker-dealer and member of FINRA and SIPC. Gulf Coast Financial Advisors is independent of ProEquities Inc. Information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Focus on the 5 offers commentary and generalized research, not personalized investment advice. Show content is for informational purposes only and does not constitute complete description of our investment services or performance. All investments involve risk and unless otherwise stated are not guaranteed. Be sure to consult a tax professional before implementing any investment strategy.